Are we on the cusp of a commercial real estate renaissance, particularly in the office and retail sectors? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. According to a recent article by Jeff Bond, published on May 14, 2025 in Scotsman Guide, the office and retail sectors may be due for a turnaround. The article highlights that office sublease availabilities have dropped by 2.6% quarter over quarter, as reported by Cushman Wakefield, suggesting a stabilizing market. This has prompted daring investors to take advantage of low prices and acquire properties in commercial real estate sectors that have been largely avoided, such as malls and office buildings. Namdar Realty Group, an investment company based in Great Neck, New York, has been at the forefront of this strategy. Since 2012, Namdar, alongside Mason Asset Management, has specialized in acquiring so-called zombie malls and office buildings at rock-bottom prices. By 2021, they owned approximately 100 malls across the country and have since expanded their focus to office buildings, acquiring 10 office properties for more than $480 million in cities like Chicago, Cleveland, and New York City. Their strategy relies on buying properties at low prices and cutting costs to improve profit margins as the economy improves. Norges Bank Investment Management, managing Norway's sovereign wealth fund, has also shown increased interest in the office sector. Earlier this year, they spent $1.9 billion to acquire the remaining shares of 8 office properties they partially owned in Boston, San Francisco, and Washington, D.C. In 2024, they purchased an office building in Menlo Park, California. This increased activity is reflected in the total volume of office building sales, which rose 20% year over year to about $63.6 billion in 2024, according to the Wall Street Journal. Cushman Wakefield's David Smith described the office sector as healing, noting that banks are becoming less conservative with lending standards and investors are more optimistic about the sector. Sublease availabilities have declined, which typically predicts a drop in market vacancy rates. Smith anticipates that vacancy rates will peak this summer or in the latter half of the year, signaling an upswing in the sector. Turning to the retail sector, Dan Diebel, an economist with CBRE Econometric Advisors, mentions that the market has downsized over the past decade and now boasts a record low vacancy rate of 4.7%. Despite retail bankruptcies making headlines, the lack of available space and minimal new retail development have kept vacancy rates low and demand strong. Diebel suggests that the declining mall inventory is beginning to look attractive to investors, as higher property valuations compress capitalization rates. The retail real estate market in San Francisco has entered an expansion phase for the first time in 2 years, according to a recent analysis by CoStar. The market's growth is attributed to an increase in leasing activity and a reduction in tenant move-outs, which has led to improved retail absorption rates. The improved conditions in San Francisco's retail sector reflect a broader trend of revitalization in urban retail markets. This upswing comes as many retailers adapt to changing consumer behaviors and are now capitalizing on the opportunity to expand their presence in key urban areas. In the Kitchener-Waterloo region of Ontario, Canada, the retail market has similarly shown signs of recovery, with increased interest from both local and international retailers looking to establish a foothold in this growing market. Retail vacancy rates have been declining, mirroring the positive trends observed in San Francisco. Meanwhile, in the United States, the retail sector's recovery is not limited to San Francisco. Many American cities are experiencing a resurgence in retail demand, driven by a combination of pent-up consumer demand and strategic repositioning by retailers to meet evolving shopping preferences. CIM Group, a community-focused real estate and infrastructure owner, operator, lender, and developer, announced the sale of Turtle Creek Village in Dallas. This mixed-use property comprises the offices at Turtle Creek Village, a 230,000 square foot, 18-story Class A office tower, and the shops at Turtle Creek Village, a 95,000 square foot grocery-anchored retail center. Acquired by CIM Group in 2017, the property underwent a significant repositioning of both its office and retail components. The offices at Turtle Creek Village have been leased to a diverse mix of tenants attracted by its central location, efficient design, sweeping area views, and abundant nearby amenities. Under CIM Group's management, the office tower was modernized to meet the needs of tenants and visitors, with upgrades to the building lobby and amenities. Notably, CIM Group constructed speculative suites featuring high-end finishes and offering an efficient and flexible design to accommodate market demand from businesses seeking smaller move-in ready spaces. The Shops at Turtle Creek Village, anchored by a regional grocery chain, offers a variety of daily needs: shops, restaurants, and services. CIM Group successfully leased the retail space to attract high-performing restaurants and retailers, particularly those focused on health and beauty categories, aligning with customer demand. This strategic leasing effort reflects CIM Group's broader community-focused investing approach, which emphasizes enhancing communities through real estate development and operations. CIM Group applies its extensive expertise in owning, developing, repositioning, and operating real estate assets to create value and positively impact communities across the Americas. Their disciplined approach, from due diligence to operations through disposition, aims to make a meaningful difference by executing key environmental, social, and governance initiatives while enhancing each community in which they invest. For more insights into CIM Group's projects, visit their website at www.cimgroup.com. In a fascinating development, Gabriel Navarro, a Miami-based retail expert and leader at MMG Equity Partners, has been making waves in the commercial real estate sector. Known for his strategic approach to revitalizing shopping centers, Navarro has extended his expertise beyond traditional retail markets. In a recent discussion with Brian Bandel of the South Florida Business Journal, Navarro shared insights into his transition from managing drugstores to breathing new life into shopping centers, and his latest venture into ski resort ownership. Navarro's journey began in the retail pharmacy space, where he honed his skills in operational efficiency and customer service. These skills have been pivotal in his ability to transform underperforming shopping centers into thriving community hubs. By focusing on tenant mix and enhancing the customer experience, Navarro has successfully repositioned several retail properties, including Kendall Corners, a prominent shopping center in Miami. The strategic shift to include ski resorts in MMG Equity Partners' portfolio marks an intriguing expansion of their investment strategy. Navarro explained that this move was driven by the potential for year-round revenue generation and the opportunity to diversify their asset base. By leveraging their retail expertise, MMG Equity Partners aims to create unique destination experiences that attract both local visitors and tourists. This diversification strategy not only underscores the flexibility and adaptability of MMG Equity Partners, but also highlights the broader trend of retail investors looking beyond traditional property types to achieve sustainable growth. Navarro's innovative approach serves as a testament to the evolving nature of commercial real estate investment and the potential for creative strategies to unlock new opportunities. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.